Hey guys, welcome back. Now, being one of the top investment managers in the world, there are times when you're going to be put under a lot of pressure. It's no secret that along with the crypto market, Cathie Wood's ARK ETFs have taken a bit of a pounding this year, with their flagship fund still down 30%. Yikes. Now, Cathie Wood has just released her monthly market update, and as always, we'll be taking a look at the key points for this month. And there's an important point every investor needs to be made aware of, as it's also a clever tactic used in the financial world to manipulate data. And we'll take a closer look at that. And so in this video, we'll be looking at what is this investing tactic that is used that can completely change the results of any investment that you're analyzing. Then one of the biggest talking points right now is that the yield curve has just inverted. And so we'll cover what is a yield curve, what does this inversion mean, and why is it important. And then we'll finish with, as Q1 has now passed us by, we'll crunch the numbers and take a look at how each asset class has performed so far this year. As always, if you do enjoy anything in the video, then drop a like. Always appreciated. Okay, first up, Cathie points out an important point, and it is one to be aware of, as it's also used to manipulate data. Ready? Let's do this.
Disruptive innovation is inherently controversial and tends to be quite a volatile strategy. If you have a long-term investment horizon, which you have to when you're investing in disruptive innovation, things tend to work out. I'm not really saying anything about the future, can't make any guarantees. However, if you look at the 5-year track record of our strategies, including the significant volatility we've seen in the last year, you will see numbers that I would put against any other active management strategy out there. We have outperformed the broad-based benchmarks, whether you're talking about the S&P, Morgan Stanley MSCI World, or the NASDAQ. And as I understand it, most active managers have not. In fact, the vast majority of active managers have not. And so, yes, we do go through periods of significant volatility. During the last 2 years, we have watched our research point to an expansion in the market cap opportunity associated with disruptive innovation from $75 trillion, which was our 5-year expectation 2 years ago, to $210 trillion, with artificial intelligence being probably the biggest reason. So we're very excited about what's going on. The momentum is in place. The valuations of the stocks in the public equity markets associated with disruptive innovation have been crushed in the last year. But if you look at the private markets, those valuations have not been crushed. If anything, we've seen an escalation. So there's a disconnect here, and we think that the private markets are onto something.
So what is this investing tactic? Well, it is the time frame, and you can completely change the results of any investment or data set just by adjusting its time frame. And something that is a terrible investment over 1 year might be a great investment over 2 or 3. And it's very common in financial services for companies to do this, as it makes their investments look a lot better for investors. So let's take Bitcoin as a quick example. Let's say you're brand new and thinking about investing. Well, over a time frame, Bitcoin looks like a bad investment, as it's down. And this could certainly put off anyone new thinking about investing. Then change this to a 3-year, a 5-year, a 10-year, and it's one of the best investments you could have made. And the same is true for the ARK ETFs. Yes, they look bad over 6 months or 1 year, but then over 2 or 3 or 4 or 5, they've completely outperformed the market, and that was the point Cathie was making. So just remember, when you hear anyone giving insights or investment advice, what is the time frame they are using? And then what do you think the correct time frame should be for that investment? Okay, next up, one of the big talking points of this month comes from the bond market, and the yield curve has just inverted.
Today, very importantly, with the employment report, the yield curve, 2s to 10s, as I started talking about earlier, inverted. And again, that's a warning to the Fed at 2.35% on the 10-year Treasury bond, which tends to track nominal GDP growth over time. So 2.3, 2.4%. That is telling the Fed, the bond market actually is telling the Fed, look, we think growth and inflation are going to be lower than expected, so be careful. We've been amused over the last, I would say it's maybe 2 months, that once the 2s to 10s started to invert, there was a shift by people who just wanted to be bullish on activity and growth and value stocks, a shift to the 3-month versus 10-year. Well, we've studied that, and the 2s to 10s, so that yield curve, is a leading indicator for the 3-month to 10-year Treasury yield curve. So I don't know why everyone took that jog at the same time. It was, as I said, amusing, but just know, at least from our point of view and from our research, the one that we place a higher priority on or place more weight on is the 2s to 10s. It's inverted. And in post-World War II experience, every time the yield curve has inverted within 12 months to 18 months, we have been in a recession. So that's consistent with the inventory and output dynamic I described a little earlier. The other thing that's a bit of a warning here, our spreads are opening up. And what that means is corporate yields relative to Treasury yields are starting to move up. And that's another indicator that bond investors are worried about the fundamentals of corporations, which of course are impacted importantly by the economy.
So one of the big things going on this month is the yield curve inverting. So for anyone new, we'll quickly cover what is a yield curve, what's an inversion, and why is this important. So when it comes to the yield curve, it's referring to the bond market. And essentially all bonds are is that you can loan your money to the government and earn an interest rate or yield. And it's known as a risk-free investment, as it's very unlikely that a Western government will go bankrupt. So there's two parts to this, and let me just keep it super simple for this example. Let's say the yield you get is 1%, 2%, 3%, 4, 5, 6, 7, 8, 9, 10, and then maturity is how long are you going to loan the money for? Would it be just for 1 month, 3 months, 6 months, maybe 1 year, 2 year, 5, 10, 20, 30 years? Now, in general, the longer that you loan your money for, you're taking more risk as an investor, as you're locking that money away. So you should get a higher yield for doing that. And if you're just going to lock your money away for a month, then you're probably only going to get a small yield. In a healthy economy, you'll have a nice long yield curve like this. Now, just ignore this line because it's not the best example. Now, think about what it would look like if this yield curve would flatten out. So it becomes more like a line, and that's what's been happening. And for the yield curve to invert, all that would happen is if the longer term would become lower than the short term, as this then no longer makes sense, as you're taking all the risk to loan your money for 30 years, yet you could get a higher yield just by loaning it for 1 month. And this signals that something is broken in the economy. And this is the actual US Treasury yields right now. So we can see the terms are 1 month, 3 months, 6 month. Then we've got 1 year, 2, 3, 5, 7, 10, 20, and 30 years. But you do get a much lower yield. So for just 1 month, it's 0.18. And Warren Buffett, this is where Warren Buffett actually keeps his cash in short-term government bonds. And if you were to loan your money for the maximum 30 years, you would get 2.4%. So it's not very high, but it's known as a risk-free investment. Now, the big thing everyone's talking about is this 2 and 10. So they're referring to the 2-year and the 10-year. So if you're going to loan your money for 2 years, you currently get 2.4%. Now, the problem is if you take more risk and loan your money for 10 years, you only get 2.3. So this is the yield curve inverting. And so this signals that something is not right in the economy. And every time the yield curve has inverted, a recession has soon followed after. Okay, and to finish up, Q1 has now passed in this turbulent year of 2022 so far. So we now have the results and we can see how everything has performed. But first up, Cathie's take.
We've seen an asset allocation shift towards crypto, towards gold. Crypto was fairly flat, as measured by Bitcoin at least, in the first quarter. Gold was up 7 to 8%, so both of those much better than both equities and bonds. And the dollar there, that was also up 3 to 4% in the first quarter. We're seeing the dollar continuing to move up against the expectations of the bears out there who believe that the twin deficit, so the federal budget deficit and the trade deficit, are going to cause an implosion in the dollar. The dollar is moving up, and I do believe there's a terms of trade reason for it. China's become more hostile to capital. Europe's in recession and on the border of a war. And the US just seems like a safer place to be right now.
And now let's take a look at the asset class performance so far this year. So we've got stocks, bonds, property, commodities, gold, and crypto. And for stocks, we'll use the S&P 500. For the bonds, we'll use the largest ETF there is, AGG, a US aggregate bond index. For property, we'll use the US, the Goldman Sachs Commodities Index for commodities, and then gold and crypto. So for stocks, in Q1, it is still down negative 5%. For bonds, which is supposed to be the safe place to put your money, it's actually gone down 6%, which is a bit shocking. Property has soared in many parts of the country, up 20%, which is huge. Commodities have had a stellar Q1, up almost 30% in just 3 months. And obviously largely to do with oil. Then gold has done pretty well, up 5%, and crypto, although had dropped 30%, has now come back to nearly break even. So this is your Q1 performance. If you're going to invest in innovation stocks or crypto, then you must get used to big volatility in both directions. Huge gains also come with huge drawdowns from time to time. So knowing which time frame you should be paying attention to is very important as to not get wrecked. Yes, over the past year, the ARK ETFs and crypto do not look like good investments. But then over 2, 3, 5, 7, 10 years, they've still vastly outperformed the market. The 2 and 10-year bond yield has now inverted, and this signals that something is not right in the economy, and historically this has always led to a recession. And when it comes to performance so far this year, then property investors and people who diversified into commodities have done very well. Stocks and bonds are currently down, and crypto is now pulled back to around break even. So it'll be very interesting to see what happens from here. So there you are, guys. Hope you enjoyed. If you've got any thoughts or comments, just leave them below. But for now, just to say, if you did enjoy anything in the video, then drop a like. And a big thank you to everyone who does. If you haven't yet subscribed, click below and join us. Got some great videos coming up that you don't want to miss. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.